Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to the 9th episode of our InvesTips from the CIO's Desk series. I'm Steve Brice, Standard Chartered Bank's Global Chief Investment Officer and the host for this series. Today I want to talk about the different options you have for the safer part of your portfolio. We're talking about investment in fixed income or bonds. Now, before we get started, I want to give a health warning. This episode is a little longer than normal and will introduce some potentially unfamiliar concepts. However, they are important concepts to understand, so I suggest you use the rewind button to make sure you grasp them if necessary. So let's start with the basics. What are you, as a fixed income investor, doing? Effectively, you're lending money to somebody, and in return, you expect to get your money back plus a pre-agreed level of interest or income. So what do you care about? You care about the ability and willingness of the borrower to pay you back. You don't really care whether the borrower struggles or does fantastically well, only that it does well enough to pay you back. Now, there are a range of different investment options in the fixed income space. So let's go through some of them and explain how they work. The safest example of fixed income is a treasury bill, often abbreviated to T-bill. They have a maturity between 7 days and 12 months. They're issued by the government in their own currency. And because the government can direct the central bank to print more money, the risk of not getting your money back is low. Of course, because of this, the returns offered are also pretty low. Technically, actually, they don't pay interest. So what do I mean by that? Well, what happens is you buy them below par, where par is the amount you'll get back when they mature. So let's make this real and give an example. So let's say the par value of a 12-month T-bill is 100. If you buy the T-bill at 95, then the implied interest rate is 5.26%, which is effectively $5, which is the difference between the par value of 100 and what you buy it at as 95, divided by the purchase price, 95. So 5 divided by 95 gives you a 5.26% interest rate. A similar investment is commercial paper. This works the same way of a T-bill, but can be issued by a range of borrowers, including companies and financial institutions. Therefore, the risk of them not being able to pay back is higher. A company cannot just print money to service the debt. But because of this, the interest rate offered will generally be more attractive, depending on how risky the borrower is perceived to be. Now, the final area I want to cover is bonds. Now, bonds can have a maturity of between 1 year and 100 years. Borrowers in the bond market include governments, companies, and financial institutions. Now, assuming the borrower does not default on its payment obligations, the investor will receive a predefined income in the form of a coupon through the life of the bond. So let's again take an example. Let's say you invest in a 2-year bond with a par value of 100 and a coupon of 8% paid semi-annually. So after 6 months, you will receive $4, which is half of that 8%, and you'll receive the same again after 12 and 18 months. After 2 years, you'll receive back another 4 plus the par value of 100. So in total, the cash flow received over the 2 years will be $116. Now, when investing in bonds, you still have to be comfortable that the borrower will be able and willing to pay you back. In addition, you also have the greater risk of the value of your bond holdings fluctuating over time. Now, to explain why, let's think about how an investor looks at picking bonds. Generally, the starting point is to compare the yield of maturity of different bonds. Now, to explain what this yield to maturity is, let's take a simple example of a 1-year bond. In this case, the yield to maturity equals the coupon plus the capital gain of holding the bond to maturity. So if you buy a bond with a 6% coupon at 99, then the yield to maturity is just over 7%. The $6 coupon plus the $1 capital gain, which is 100 minus 99, divided by the purchase price of 99. Now, if the general level of interest rates goes up, then existing bond prices will typically fall. Why? Because new bonds are issued all the time. And if other bonds are issued with a higher yield to maturity than your bond, then that becomes much more attractive to your bond, and therefore the price of your bond will generally fall, and that increases the yield to maturity on existing bonds, right? Driving down the price means that it widens that gap between the par value and the price of the bond, which therefore increases the yield to maturity. And this impact is more significant for bonds with a longer maturity profile. So again, tried to work through this with a couple of examples. For a 1-year bond, if the interest rates suddenly rise by 1%, the price will approximately fall by about $1. Okay? If you own a 10-year bond, to push the yield up by 1%, a prospective buyer of the bond needs to be compensated for 10 years of that 1% lower coupon on offer. And very roughly, due to complicated maths, but very roughly the bond might fall in that scenario by around 8% on a 10-year bond to achieve that. Now obviously the reverse happens if interest rates fall. So if interest rates fall, bond prices rise. Now this has important lessons for investors. First, if you hold to maturity and the borrower doesn't default, you still get back what you expected. However, if you want your money before the bond matures, then you won't know exactly how much money you will receive until you sell it. Therefore, if you're merely trying to get a better level of income relative to bank deposits, then trying to figure out how long will be before you need that money will be really important to pick bonds and try and make sure that you get the right maturity profile. It may of course be tempting to look at longer maturity bonds because they generally offer higher yields. However, as discussed, this comes with increased risks. Now the final thing I want to discuss is the how-to part of investing in fixed income. The discussion so far assumes that you are picking the bonds or bills to invest in. However, an alternative route is to pick a fund or an ETF instead. This makes things a lot simpler for you, gives you more diversified exposure and thus lower risk. However, the cost is twofold: a reduced ability to tailor things to exactly what you want, and the fact that you will need to pay a management fee. That said, for beginner investors, a diversified exposure through a fund or an ETF is almost certainly the best way to invest. And once you get more comfortable with investing, you can consider picking some bonds yourself or with the help of an advisor. Well, thank you so much for joining me, and also thank you for your patience. I realise some of the concepts might be new to you, but the concepts are really important for you to understand as you start investing for higher income. In the next episode, we'll talk about how to generate income from your equity investments. Thanks again, and I look forward to catching up with you then.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.